we're very grateful to have this opportunity to get such a great panel together, and so many of you that have been tuning in every 2 weeks to listen to this as we take a look at what's going on in the markets. Today we're going to talk generally about the public markets, and we're going to look at the private markets. And if you've been following the stock market, if you are involved in any M&A whatsoever, you know that there's a lot going on out there. And we want to try to understand really what's driving this, how the election that's coming up, the big election in November, might affect everything that's going on out there. And we have this amazing panel, which I'd like to go ahead and introduce to you, and then we'll jump right into this. So returning for the second time, Salita Marcelli, who is the Chief Investment Officer Americas for UBS Global Wealth Management. Salita, it's great to have you back here. Salita is responsible for bringing together market and investment insights to optimize impact for UBS Americas clients with over $1.3 trillion in total invested assets. She's a member of the Global CIO and WM USA Management Committees, in addition to serving on the Global Investment Committee, which is responsible for formulating the UBS Global Wealth Management Investment House View. We're also very happy to have Paul LaMonica joining us today. Paul's a digital correspondent for CNN Business. He writes daily about the markets and blue chip companies, and also appears regularly on CNN International Business Programs. He tweets throughout the day on Twitter and stock twits at LaMonica Buzz. Paul previously was an assistant managing editor overseeing the site's economic, markets, and technology coverage. He's been with CNN Business since November 2001 and previously worked for Red Herring, Smart Money, American Banker, and Financial World. He lives with his wife and 2 sons in Brooklyn, New York, and is a 1995 graduate of the University of Pennsylvania. Winston Shows is also joining us from our good friends Houlihan Lokey. He's a senior vice president in Houlihan's Transaction Advisory Services practice, specializes in M&A tax services. He's a transactional attorney with experience in domestic and cross-border tax due diligence, tax structuring for both private equity and corporate clients, and bankruptcy restructuring tax planning, and he's based in Houlihan's Dallas office. All right, so it's our custom that I do the introductions, which means that my partner, Chris Keefe, gets the first question. I know, Chris, we have a lot of questions for Salita. You want to go ahead and kick us off?
Terrific. Thanks, Bill, and welcome everybody today. And thanks again for being with us for another great session. We are thrilled to have such a august panel with us today, including a return guest, as Phil said, our friend Salita. So Salita, we were anticipating, I think the last time you were with us, a pretty tremendous recovery, at least from an equity market perspective. You know, we've seen a real surge of 60% off of our March lows in the S&P. But recently, obviously, we've seen a tremendous amount of volatility. What's behind that?
Okay. First of all, thank you so much. It's a pleasure to be with all of you, and thank you for inviting me back. So, you know, let's look. There are a number of reasons why this is happening, but let me take maybe a quick step back. So, as stocks continue their swift recovery from COVID-19 induced bear market, it felt like we were hitting a new all-time high every day throughout the month of August, right? With that, volatility seemingly woke up earlier this month with stocks selling off. The decline was led by the tech sector, which is very well publicized, as NASDAQ entered a correction territory. So the question is said, what changed that disrupted this market rally that was happening pretty swiftly just only a month ago? So first of all, tech stocks have benefited from stay-at-home trends during COVID-19, rising over 70% from the lows, from the March lows. And in early September, we began to see somewhat of a rotation out of technology stocks as investors started taking profits. On top of that, speculation that a vaccine could be available sooner than expected which would accelerate the economic recovery, I believe added to this sector rotation from technology into areas that would benefit from a broader economic growth. So that was one, right? And then you had equity options related selling that played an important role in the tech sell-off. Option flows and relating hedging activities are usually just one of many buying and selling flows in the underlying securities, and they're not major drivers of stock prices. But the recent accumulation of long call option positions in large tech names, essentially, if you want to make a bet that the stock is going to go higher, instead of buying the stock itself, you're buying an option where you can buy the stock at a predetermined price, right? So those accumulated positions in large tech names has contributed to a large declines as option dealers had to sell into a declining market. Meanwhile, you had fears of renewed lockdowns globally due to COVID-19. And I think that was a large contributor to the most recent sell-off that we just saw throughout, this week, Monday and yesterday as well, as countries like France and the UK within Europe have experienced recent spikes in their cases. And while hospitalization rates have dropped in the United States, we still have a way to go in combating the spread of the virus. And then finally, I would say policy uncertainty has also increased volatility. Especially, we've seen a lack of progress on another U.S. fiscal package. Although today there's news that Secretary Treasury Mnuchin and Nancy Pelosi might be starting to talk again, but let's see. And the passing of Judge Ruth Bader Ginsburg has only fueled the partisan divide, which makes a fiscal package even more unlikely before the election. On the foreign policy side, you have tensions between the U.S. and China over technology, and that continue to rise, and we expect this to remain as we head into the election, as both Biden and Trump want to be seen as really being tough on China. So, when you put this recent sell-off in perspective, yes, this brings the S&P 500 and NASDAQ near levels seen in early August. So it's important, I think, to look at this recent activity in the context of the ongoing rally that's taken place over the last 6 months. While we do expect volatility to remain elevated for the time being, right, overall, we believe equity markets will move higher over the medium term. And we think the best strategy is still to stay invested according to your financial plan as opposed to trying to time the market, especially given how sensitive stocks currently are to the every bit of news around vaccines, stimulus announcements, and of course, more stuff around the U.S.-China relationship.
So Lita, you talked about tech sort of leading the way and being a large contributor to the rally. As we look into 2021, do you see tech again leading the rally, or do you think that there are other segments of the equity market which might drive, the next rally?
Yeah, I mean, it's always hard to bet against U.S. tech sector, and I think growth stocks 35% outperformance over value stocks so far this year shows how costly that can be from an asset allocation perspective, right? This outperformance has largely been driven by low interest rates, growth stocks leverage to stay-at-home trends, and uncertainty about the sustainability of the economic recovery. But for equity markets to move meaningfully higher over the medium term from where we are right now, I believe this concentrated rally will need to broaden out, right? And, while many of the drivers for growth I just mentioned may still be intact, the prospects of a sustained period of value stocks outperformance may be rising as well for a couple of reasons, right? First of all, value stocks earnings are expected to fall about 35% this year compared to 8% drop for growth stocks. But if a successful vaccine early next year leads to a full reopening of the economy, then we could see this earnings trend almost flip. And then secondly, broader economic reopening could also eventually lead to a modest rise in interest rates, which would favor cyclical value stocks, especially financials. And lastly, I would say it's clear that growth stocks benefited from a bit of speculation, right, especially in the month of August. But investors may be less willing to speculate in growth stocks and push valuations higher after the warrant suffered recently, with some tech names selling off really sharply. So right now, we remain neutral between growth stocks and value stocks as we await more clarity around key factors that should support value names and financials and maybe some energy. And that is, specifically a vaccine, which would allow economic conditions to truly normalize. And just to add here, our current expectation is that a vaccine will be widely available by the second quarter of next year. One area within the U.S. equity market where we have higher conviction is within our size preferences. We currently prefer mid-caps versus large-cap companies. Mid-caps have lagged so far this year, but are more cyclical and have room to play catch-up as the reopening process gains traction. And within our sector positioning, we maintain a moderate cyclical bias as well, with preferences for consumer discretionary, healthcare, and industrials. And while we believe cyclicals will outperform as the economy recovers, a modest tilt appears more appropriate until we prove that COVID-19 can be, truly defeated.
Alita, switching gears for a moment, we noticed earlier in the month that the Fed has adopted a more nuanced policy when it comes to balancing its employment and inflation mandates. What does that change tell us about sort of the process that the Fed has gone through in terms of the life cycle of the pandemic?
Mm-hmm. So the Fed has been hinting at its intention to adjust its policy framework around inflation, and this finally came to pass in late August when Chair Powell introduced the average inflation targeting at the annual Jackson Hole Summit. Average inflation targeting basically provides flexibility for the central bank to let inflation pass its 2% growth target for a certain period of time in order to make up for prior undershootings. And this ultimately means that the Fed is willing to tolerate higher inflation for a tighter labor market. Now, this change underscores, I think, the Fed's overall stance during the pandemic, which has been to support the economy at all costs. The central bank has continued to reiterate it is not even considering raising rates anytime soon, and confirmed in its September policy statement that it expects to leave rates near zero through at least 2023, right? From a market's perspective, we believe that short and interest rates will remain capped by the Fed's actions, obviously. And we would expect the longer end yields to trend slightly higher as the market prices in slightly higher inflation expectations. But I think even the long end of the curve, the long-term rates, even moving up from where they are right now, would still, when you look at a chart over many years, would be close to their historically low levels for the foreseeable future. Now, we also, when we talk to our clients, we recommend, for example, an allocation to TIPS, Treasury, inflation-protected securities as an alternative to nominal government bonds to protect against modestly higher inflation, as well as we talk about gold quite a bit. To be clear, we really do not anticipate that the Fed is willing to tolerate inflation that greatly exceeds the 2% target. So I think any thoughts of the 1970s should be faded from that perspective. And I think the Fed's willingness to keep interest rates lower for longer is also likely to contribute to the depreciation of the U.S. dollar over the medium term. Low interest rates, I think, makes the dollar a less attractive option for foreign investors, especially when we consider that real interest rates or inflation-adjusted interest rates in the U.S. are negative. With respect to, equities, Fed's actions recently, its impact on equities, I would say accommodative Fed policy should be a tailwind in general, especially when we're thinking through the lens of the equity risk premium or the of return offered by stocks over U.S. Treasuries, lower interest rates make bonds less competitive compared to equities on a yield basis, so valuations can rise further than would normally be warranted if the interest rates were higher. And that's why when you're seeing these tech companies with, price to earning multiples, that is almost like making people feel like, are we in the dot-com bubble again? But the times are different and the interest rate levels are so drastically different that this is becoming, these types of valuations are becoming the new norm because of Fed policy.
Lita, thanks for explaining that. I mean, inflation, interest rates are on everybody's minds right now and wondering if this is going to be the decade of inflation. So thanks for explaining that. I want to switch and talk a little bit about the big election that's coming up and how that's going to affect the markets. We understand that the Chief Investment Office team at UBS has outlined 4 possible election scenarios, right? 2 that involve a unified government, a blue or red wave, and 2 that involve a divided government. So overall, how do you expect the market to react under each scenario? And then what specific winners and losers do you expect to see emerge from that?
Of course. So obviously, this is a topic that is top of mind for most investors. Maybe I would not exaggerating, maybe all investors at this point. And it's the topic we talk about most frequently. We actually, we've been publishing reports about implications from different, on different areas of the market for quite some time. We just published another one just last night as we, have all these new twists and turns in this saga, I would say, with the Supreme Court and no fiscal stimulus on the horizon. Anyway, so when we assess the market impact of the election, I think it is critical to consider both the outcome of the presidency, of course, and the outcome for Congress, because whether we see a unified or divided government could be just as critical for investors. And, this is because gridlock in Washington will make passing certain pro-growth legislation very difficult if you have this gridlock obviously with the divided government. So as of right now, the scenario that we see as most likely, you see it in the polls as well, is a blue wave, and we would expect the scenario to be generally neutral for the overall U.S. equity market. Now, I'm sure you're seeing the same headlines that I'm seeing, which shout that the market will tank under Biden, but we continue to stress that under a likely unified government, his ability to push through fiscal spending and stimulus on healthcare, infrastructure, and other initiatives would more than offset the headwinds from higher taxes. And we would also expect trade tensions to cool to some extent, as Biden would be less likely to use tariffs as a key strategy. But of course, that does not mean that we won't see winners and losers emerge, right, as a result of Biden's agenda. And one main driver of this would be his plan to tie infrastructure spending to his goal of achieving net zero emissions economy-wide by no longer than 2050. At the sector level, green spending initiatives could benefit industrials, materials, and segments of technology and also utilities. But then there are other areas of the market that could come under significant pressure. A likelihood of greater regulation could hurt segments of the energy market, right, as Biden looks to move away from fossil fuels. So, I think the negative impact on energy is much more real. On the financials, I think if there's any regulatory comes there, I think it would be much more on the consumer finance side than a wholesale change in regulations for big banks like we've seen after the last crisis. Now, in the less likely scenario that Biden wins but fails to capture the Senate, we would expect a slightly negative impact on the economy and financial markets. And this is because Biden would still eventually push through his regulatory agenda. However, his ability to pass any major fiscal spending packages aimed at boosting the economy would be much more limited maybe outside of any bipartisan COVID-19 relief. And maybe switching to a Trump win, when looking at the possible outcomes under Trump administration, the story is flipped, right? We are far less likely to see a unified Republican front following the election, even if the president wins. Overall, we believe this would be a broadly neutral environment for U.S. equities as well. So, you know, blue wave or Trump wins, all neutral for U.S. equities. Although investors would be highly attuned, I think, to the probability and timing of additional fiscal stimulus in response to COVID-19. The current stalemate in stimulus negotiations highlights the risk of a divided government when economy is weak, and further government support could be really helpful right now. So the fate of the next fiscal package could be an even more important factor if this outcome occurs. But I would say, aside from the neutral impact for the overall market, there will, of course, still be some specific winners and losers. For example, regulatory risk around Biden presidency would fade in areas like energy and financials, and that would provide a boost to these sectors. And in the less, likely chance where Republicans are able to capture the House, we do see a red wave, right? That it's Trump and the House is all Republican. And we would have a slightly more positive outlook on growth in U.S. equities, as the president would, have a much greater chance at passing some of the fiscal policies that we've already talked about.
Salita, thank you very much. And Paul, we're going to turn to you now, because the question that we just walked through with Salita with respect to the equities market, it touches a number of other markets as well, and it's a big question worthy of spending some more time on. And we're thrilled to have you here with us today. For those of you who don't read and watch Paul's work, you always feel after you've done so that you've sort of been in touch with a friend on the inside. So we're thrilled to have you with us today, and thanks again for taking the time. From your perspective, what does that Biden win and blue wave look like to markets?
Yeah, I agree with Salita that there could be some reservations on the part of investors if you do wind up having a blue wave. But I think that the key thing, and Salita mentioned it, and a lot of sources I talk to point this out as well. Yes, we likely will have a higher tax rate if Biden is victorious and you wind up having the Senate go blue as well. But it's not going to be likely such a significant increase in the tax rate that it would really cripple the economy when you consider that you could very well have more infrastructure spending, which would be very good news for the job market and for many blue chip companies in America. So I think any worries about higher taxes would likely be offset by some stabilization of GDP and the possibility that earnings will rebound as well. So I'm not so sure that investors have to run away from stocks if Biden wins and we also have the Democrats taking control of the Senate, even though it would mean one party controlling everything, because I think it's, very likely, obviously, if Biden wins and the Senate goes blue, that means that the House probably stays in Democratic control as well.
Paul, again, thank you for joining us today. It was interesting listening to Salita talk about mid caps versus large caps. I want to ask you a variation of that, which is, are smaller U.S.-focused companies likely to outperform the blue chip multinationals, in the S&P 500?
Yeah, that is a great question. I've written about that recently on CNN Business. And if you go by historical norms, going back to elections going back to 1980 when Reagan won, or even further back than that, small caps typically do get a nice bounce in the year after an election. There is this renewed focus on domestic policy, and I think a lot of people feel that could happen again if Biden wins or if Trump gets a second term. I think one thing that really would potentially favor a lot of small caps is that many of them that are going to try and expand, be it taking on more debt, refinancing at very attractive interest rates, you're very, very likely to have the same monetary policy that we have currently. Because I think that despite all of the jawboning and criticism of Jerome Powell that President Trump seems to be fond of doing on Twitter, he hasn't given him a nickname yet, at least. So I guess that's one good thing for Jerome Powell. He doesn't have a derogatory nickname. You got to think that if Trump wins re-election, he can't throw Powell under the bus and say, I lost because of you, in the way that George H.W. Bush sometimes was thought to be maybe, undermined by Alan Greenspan raising rates before the 96 election. So I think that Jerome Powell likely gets a second term as long as he wants it. If Trump is reelected, then you play the flip side. If Joe Biden wins, you look at what Jerome Powell has done to try and support the economy and the financial markets. I would be stunned if Joe Biden, out of spite, decided he didn't want to stick with Jerome Powell just because he was, quote unquote, Trump's guy. Because if you look at historical precedent, Biden's former boss, Barack Obama, he had a chance to make a new Fed chair right off the bat in the midst of a crisis in the Great Recession. He didn't do that. He stuck with Ben Bernanke in 2009, even though that was a George W. Bush appointee. He later obviously went with Janet Yellen after Bernanke's second term. But I would expect that if Biden wins, unless Jerome Powell doesn't want the job anymore, it's his. And I think the markets would be very reassured by that. Whether or not it helps Main Street and the average economy eventually remains to be seen. Low rates do take a longer time to trickle down, but you look at the housing market, that's clearly one area where consumers on Main Street have been benefiting from these low rates that Jerome Powell has put into place.
So Paul, let's stick on that subject and sort of look at things from a sector by sector standpoint. I guess housing then would be one, given the prolonged low rate environment, that might benefit under either a continued Trump administration or Joe Biden winning the election. Talk about some other sectors that might particularly benefit from a Biden win or a Trump win.
Yeah, I think if you do have a Biden win, you would probably see Tesla, which has already obviously had an amazing run, continue to do even better. We've seen clearly in certain states where you have Democrats in control that they are trying to phase out the sale of, California, for example, sale of gas guzzler cars by 2035. California looking to do that. Not sure that Joe Biden would look to have a national initiative to cut back on fossil fuel in automobiles, but clearly I would imagine there'd be a bigger focus on clean tech and renewable energy under a Joe Biden administration than what we've seen with Donald Trump, where it's really more about protecting the legacy, old, if you will, energy businesses of coal and oil and other fossil fuels. So I think that's one area that we would clearly see from a Biden presidency. The one big issue I think that's going to be interesting is what happens to tech stocks in a Biden presidency. Is it markedly different than what's happened with the Trump administration? I think that some tech companies have benefited from the Trump backlash against China, which might continue under Biden, but it might be a little more diplomatic. But by the same token, Trump has obviously gone after big tech companies out of concerns due to antitrust issues, and that might not be something that would go away under a Biden presidency. I think there's a fair amount of bipartisan support for the notion that companies like Amazon and Facebook, Google owner Alphabet, even Apple, they've gotten way too large and make up such an inordinate amount of the market cap weighting of the S&P 500 that they're really just crushing all the other competition in the tech sector. So I think that's going to be one that's going to be interesting to watch regardless of who wins.
Paul, I wanted to ask you about, a scenario or the possibility that the actual outcome of the election may not be known right away, right? Or there may be a challenge, to the election results. How concerned are investors, about those notions right now?
Yeah, I don't think investors are overly concerned yet, even though I think they should be. And, clearly we're seeing more alarming comments from the president about what might happen if the election results don't go his way. I think that the big wild card here is that at the end of the day, when you go back to 20 years ago in 2000, we kind of all knew, hanging chads notwithstanding, ultimately there was going to be a concession by either Al Gore or George W. Bush. They weren't going to let it get to the point where we had this constitutional crisis. This current president is obviously a maverick in every sense of the word. There really is no precedent that you can look at, and investors might have to be prepared for the possibility. I think it's a minute one, but it's a small chance that we get to Inauguration Day, and if President Trump is still challenging a possible defeat, or if Biden challenges a defeat for that matter, if there's no clear-cut winner, you wind up having acting President Nancy Pelosi, which I don't think anyone is really in the market trying to figure out what that might mean just yet. I mean, they may not be panicked about Nancy Pelosi herself per se, but just what the mere notion that we might have a President Pelosi means about this constitutional crisis that could happen. That's something that, it's a trite term that the market hates uncertainty. What's more uncertain than a president who potentially loses refusing to give up the Oval Office? That's uncertainty cubed.
In the middle of flu season and a resurgence of a global pandemic.
Yeah, not to mention the possibility that we could have all of those other negative factors coming into play. I mean, if we have a second wave of COVID and a double-dip recession, assuming you think we're almost out of the current recession that began earlier this year, which is debatable, it obviously would be catastrophic, I think, to the financial markets if we had an election outcome that is not finalized by early January of 2021.
Terrific. So, Paul, we're probably going to come back to you towards the end of our conversation with a couple of additional questions, but we'll turn to Winston for a moment now. Winston, thanks again for being with us. Sort of keeping along the lines of trying to predict the future a bit. I know that Houlihan Lokey's done a number of sort of hypothetical scenarios to understand potential transaction tax impact of a Biden tax plan, especially in terms of middle market transactions. Could you give us a little bit of an overview of the work you've done there?
Absolutely. So once Biden's proposed tax plan was published, we wanted to understand what the true impact to our middle market kind of private company client base would be. As M&A professionals, we tend to think of deal value in terms of EBITDA multiples. And at Houlihan, we work with a lot of founder or management-owned companies that are going through the M&A process for the first time. And a lot of these individuals tend to care less about an EBITDA multiple and more about the cash in their bank account at the end of a transaction. So let's take a very high-level, simple example that focuses just on the proposed change in the federal rates. So if you've got a $50 million EBITDA business that's sold at a 10x multiple or $500 million, under the current tax law, the net cash to the seller in that scenario would be $400 million. So under a Biden plan, the net cash to that same seller would be $302 million. So if that seller is focused on just the amount of cash that's going to be in his pocket after all taxes are paid, in order for him to get that same $400 million of net cash proceeds under a Biden plan, it would take a total purchase price of $662 million. So putting that back in terms of multiples, we would go from a 10x multiple to a 13x multiple just as a result of the tax changes, and that's a 3-turn increase. And one of the items that remains to be seen is whether sponsors and other buyers are going to be willing to adjust valuations to take into account a seller's tax sensitivities. However, given this fairly large potential swing in after-tax cash, we are seeing some movement among sellers who are informed of these tax proposals.
Winston, again, thank you for joining us. The last part there that you just mentioned, talk some more about that. You know, are you seeing an impact of a potential Biden presidency, you know, on these private M&A transactions?
So, and we are, and here's where I have to give my 5-second Houlihan Lokey commercial. So Houlihan consistently ranks, you know, #1 in terms of total numbers of transactions. And as the senior member of our M&A tax group, I have insight into a large number of both live transactions and proposals. And information regarding the Biden tax proposal has kind of become standard inclusion in our pitch books. And the plan is generating an increasing number of questions from potential private company sellers. One of the frequent questions from sellers regarding deal timing is whether the potential tax changes, if passed in 2020, would become effective in 2021 or be retroactive to January 2020. So obviously there's a lot of political considerations of when tax changes would be effective. That goes back to, you know, the blue wave and whether the Democrats would take the Senate, whether they would eliminate the filibuster, and a bunch of different other factors. Sellers that I've talked to tend to be split on the issue and how they view this. However, potential sellers that were already considering an exit or were on the proverbial fence have been less likely to bear the burden of a Biden tax plan, and they've accelerated their sale processes. So anecdotally, just in the past 4 weeks, I've been involved in 3 separate transactions where the seller has explicitly stated that they were accelerating the deal process because of the proposed Biden tax plan and their view of the overall election outcome. And we've seen other deals accelerating for various other reasons. And, you know, I can surmise the potential tax changes, you know, were at least one of the many factors going into that decision.
Winston, outside of the proposed legislative changes to the tax code, are there other regulatory changes that could materially impact transactions?
Absolutely, and I'm focusing here just on tax regulation. So changes to the tax code would obviously have to go through the legislative process. So, you know, if a Biden tax plan were done like the TCJA in 2017, it would be through budget reconciliation, which obviously has its limitations. You know, alternatively, you know, a filibuster could be eliminated in the Senate that would, you know, switch everything to a straight majority vote. You know, however, the tax regulatory changes can happen outside of the legislative process, and they don't take the literal act of Congress. So in September of last year, proposed regulations were introduced that would greatly reduce the value of net operating losses in M&A transactions. For any tax aficionados out there, I'm referring to the recognized built-in gain provisions and the rolling back of the primary benefits described in Notice 2003-65. And companies don't necessarily have to follow these regs until they're final. And given the punitive nature of the NOL restrictions from these regs, I don't anticipate that anyone is or will be following them until they're final. These regulations have been sitting out there with no movement for almost a year. But we always hear the term loophole, and NOLs being used to reduce or eliminate taxes is one of those, you know, quote unquote loopholes that often comes up, in especially during election seasons. So if you saw a Biden administration take over, I could see these NOL regulations being pushed to be finalized on a fairly quick basis. And that would have a material impact on how NOLs are valued in transactions.
Thank you, Winston. So other than the proposed rate changes, are there any other components of the proposed Biden tax plan that you think will impact middle market transactions?
So I think most of the other impacts from the proposed plan will be on valuations that are tied to cash flow. So one example, if you recall, the 2017 TCJA eliminated the alternative minimum tax, the AMT, but it also restricted the use of NOLs to 80% of taxable income. And this created what at least I personally called kind of a backdoor AMT. So Biden has proposed what is essentially a reintroduction of the old alternative minimum tax, where a company that may have zero taxable income would still pay tax based on a modified book income. So you could see situations where there are companies that would otherwise not have been taxpayers paying two separate AMT tax-like liabilities. And it's changes like this that will impact cash flow models that especially a lot of private equity and sponsor buyers use as the backbone of their valuation models. In addition to the federal tax changes, I do expect that many states will see substantial changes in their tax codes. First, if a Biden tax plan is enacted, many states will automatically, under their current law, adopt any provisions that are in the Biden plan. Other states have optionality where they can either adopt the federal code or not. But you may also see rate changes across the states, and this may happen regardless of the outcome of the presidential election. For example, California has proposed increasing their top rate from 13.3%, to over 16%. I personally am a resident of suburban Dallas, Texas, and I can personally see the impact of the California tax rates in terms of the companies relocating here and the neighbors that are moving in my neighborhood. So an increase in those rates, especially in California, may drive more mid-market business operators to low-tax jurisdictions like Nevada and Texas.
Thank you, Winston. Appreciate that. We have a whole bunch of audience questions, which Chris and I are going to, thankfully we've got some time today to get through them. But I have a question, and Paul, maybe this is for you, and be interesting to see what Salita thinks as well, which is, after 9/11, right, our government spent a lot of money on Homeland Security, right, trying to shore up at the national level, the state level, even down at the city levels, town levels, and I'm sure that made its way through the economy. And right now, the heavy emphasis obviously is on getting a vaccine, right, to market. But beyond that, spending money to bring manufacturing onshore for critical PPE equipment, to various military drones and various things. I mean, what are you seeing? What are you expecting for a government spend, and how do you think that affects the market?
Yeah, I think that clearly there is going to be a very strong emphasis on trying to get not just maybe a vaccine, but multiple vaccines into play that people will feel comfortable actually receiving, and then hopefully that gets us to a point where the COVID-19 crisis becomes far less severe. If we feel like there is enough of an immunity buildup that people can go about their regular business and way of life, both consumers and corporations. With regards to government spending, though, the thing that I would harken back to is, remember what everyone was talking about in 2016, back when we all thought Hillary Clinton was going to be the next president? Everyone was basically saying, well, we're going to get a big infrastructure spending plan, but you know what? If this Trump guy actually pulls off one of those miraculous upsets and wins this thing, we'll still get infrastructure spending. We're still waiting. He obviously won, and he talks a good game about infrastructure spending, and obviously there is a lot of questions about what type of spending we need. Is it going to be more to physical, old, aging infrastructure in transportation? Is it going to be shovel ready? Is it going to be more digital modernization? But I think that if Trump wins and he has a mandate and a second term, you would think would behoove him to really try and cement his legacy, pardon the pun, with more infrastructure spending to improve the job market and the broader economy. By the same token, I think Joe Biden would want to do a big infrastructure spending plan as well. You could argue that if this economy remains as vulnerable as it is to COVID-19, we need some sort of New Deal, and infrastructure spending could be it, with bipartisan support.
Yeah, thank you, Paul. Salita, interested to hear what you think. And also, you know, we've seen an acceleration of a lot of trends. A lot of them sort of rely on digital, right? And so that makes me think about 5G and maybe even 6G, you know, which we're still struggling as a country to get to. So interested to hear your thoughts on all of that.
Yeah, I mean, yes, I would echo his perspective, and I think, you know, in terms of infrastructure or government spending, I go back to this importance of divided versus unified government, right? Because even if Trump is elected for the second time and still with a divided government, might be still dealing with a similar challenges as well. As you know, one of the main reasons that we have a stalemate in fiscal stimulus is the sticking point is the support for state and local governments, right? So I think if we have a unified government on both sides, which is more probably likely with a blue wave, then I think we might see the level of spending that is much broader, right, for the economy and infiltrates into areas that Biden cares about, that we talk about green, you know, especially having a green economy, Green Deal, right? So that's the intent, but you need to have the political structure to be in place as well. But the other, I think, important point to highlight here, you talked about PP and those things. I mean, deglobalization has already been in the works for a number of years, right? But I think the pandemic probably has done more damage to globalization than all the U.S. and China tensions that we've been seeing over the last couple of years. And I think over the next decade, we expect the world to see more reversal of that globalization trend, especially because technology has enabled more localized production, and this pandemic in particular has exposed vulnerabilities and risks in our current supply chains, especially with regard to goods deemed critical to global health and safety, like pharmaceuticals and defense equipment. So I do think that you know, there is going to be probably more money that is coming because we have been, or because the globalization trend is also being accelerated, and a lot of these vulnerabilities have kind of resurfaced.
Maybe this will be a jump ball for the panel, but a couple of the industries that we really haven't talked about, although we've talked about pretty extensively on previous programs, are sort of the hospitality and travel and commercial real estate. Obviously, the first was one of the first to be so grievously wounded by the COVID pandemic, and but the other one is sort of a looming problem that I think landlords and banks have largely covered off on until now, but would be interested in the panel's perspective on what they're seeing and hearing in the market with respect to the long-term prognosis for those two industries.
Sorry, Chris, you're talking about hospitality and...
Yeah, hospitality and travel and commercial real estate.
Yeah, and I mean, how do they recover, right?
Right.
Yeah. Until we open up things, you know, how do people get comfortable traveling again? And I think everybody wants to travel. I know everybody in my house wants to travel.
With or without you, right?
Right? No, without me.
Yeah. Some stats I've seen say it's, you know, the best you can hope for is 80% after 5 years, and you know, it's just very hard to get a handle on.
Yeah, I'm happy to take a stab at that if you want. I actually just wrote a story for CNN Business about commercial real estate and pointing out that it is striking that while we have a booming housing market right now, so many people are willing to leave cities for the suburbs, and you're seeing, thanks to low mortgage rates, this just explosion in demand for housing, be it new housing or existing housing, and housing prices going up. Commercial real estate has been in stark contrast to that. They have been left behind and are really one of the biggest laggards in this recession. People I spoke to said that, unfortunately, they're not expecting any major comeback for offices or hospitality anytime soon, because just look, I mean, we're all doing this conference call, I believe, this video chat from our homes. We're not in our offices. I don't have any real inclination on when people are going to be going back to the office, particularly in areas like New York, anytime soon. So companies are reconsidering what the office looks like for the future, and that's hurting, obviously, big landlords. But you are seeing pockets of strength in commercial real estate. People I spoke to said that self-storage units, obviously, that is an area where there has been significant demand as people try and declutter. If you have your home office, you got to get rid of a lot of stuff in order to make your space more efficient. You have places, pockets of retail and restaurants even, that are booming because they're doing more takeout orders, they're doing more deliveries and pickups. So you're still seeing some of the hospitality areas doing well, although not obviously hotels. I think that's going to be an interesting dynamic going forward, that there will be areas of commercial real estate that are going to thrive, but some are not going to be doing that well. Retail, obviously retailers are struggling, but any company that needs to have a logistical system to store goods that are being shipped. I mean, think of all the things that we get from Amazon. That's an area that you're seeing an explosion as well. You're having all of these companies that need to set up their warehouses and factories for the proverbial last mile of delivery.
Yeah, malls as micro-fulfillment, right?
Sorry, I didn't hear
Go ahead, Salita.
No, I was just going to maybe comment on the also on the office market and retail. I mean, the views are not that different. I think it's too early to write the epitaph for the entire office sector, as I think there are a number of counterbalancing forces at work. However, the reality is that landlords, companies, and tenants alike will be all forced to improvise, adapt, and really overcome a number of challenges in this new world. Like Paul said, companies will be faced with the realities of configuring space to accommodate proper social distancing. I think landlords, faced with significant capital spending requirements to enhance building safety. Employees are faced with the prospect of being in close physical proximity to a large group of people. So I think some markets will benefit from an inflow of jobs, leaving more dense markets. Suburban office could see a revitalization, for example. Newer, more environmentally sustainable buildings could see an increased demand and pricing power, maybe while older and lower quality buildings could realize lower demand and significant capital and leasing costs. And, some industries are more conducive to an office setting, and owners of buildings, housing those industries will likely fare better than their peers to focus on industries that can tolerate more flexibility. And I think landlords that heavily embrace the co-working situation are likely to see significant changes. How quickly the world changes, right? We've gone talking about WeWorks of the world to where we are now. A number of tenants, I think, may seek shorter duration leases going forward, and this could, I think, create challenges for landlords given the capital-intensive nature of tenant improvements and leasing commissions. And CapEx, I think, cost sharing could become even more of a commonplace in the future. And in terms of, retail, you guys were touching on it a little bit. I think despite a significant number of store closures and retail bankruptcies over the past several years, the U.S., as we know, still remains very over-retailed. I think the U.S. has, the last time I looked at numbers, has like almost 40% more retail capacity per capita than Canada, 5 times that of UK, 10 times that of Germany. So the size of the average mall shopping center has grown significantly over the years. And as the world of brick and mortar retail evolves and likely shrinks, battling these large centers will become even more challenging. Obviously, not all retail is alike. I think that one of the key ways for traditional retailers to compete against online is through experiential concepts. I think traditional retailers will likely have to employ new services that might include low-touch environment with more cashier-less checkouts, self-service options, perhaps more personal shopping offerings. So I think it's really not black and white, right? There are things, like we always say, there's going to be winners and losers. It's all about how agile you can be in this environment.
Yeah, thank you, Salita. That was very well said, and it's interesting. I'm going to go to New York City next week for the first time in 6 months. I used to go regularly, and anyone who knows me knows I stay at the same hotel every time I go there. But the rates are 25% of what they normally are, what I normally pay for them. In fact, I'm going to spring for a bigger room and still be at 50% of what I used to pay. It's going to be hard to go back when things get back to normal. But it is interesting, Winston, I'm sure your experience at Houlihan is the same as ours at Nixon. In the private M&A market, we're seeing, a tremendous volume of deals, that started about 3 or 4 weeks ago, looking all to sort of be, closing November, December, around the time of the election or right after the election. And it's going to be interesting to see what happens in the election and if that continues, especially if it's a blue wave, and we're expecting the kind of tax changes that each of you and Winston was describing. So these are really fascinating and interesting times. One other observation I'll make, and Chris, I know we got to wrap this up soon, is, in the 25 or 26 years I've been doing this, I've lived through a number of recessions. And typically, like in 2010, 2011, all we did were distressed deals. And then we go back to premium deals, and we've had an amazing run of premium deals since then. And this is the first time in my career where we have, to your point, Salita, of winners and losers. We're doing distressed deals at the same time that we're doing premium deals, like very high multiple deals like we were seeing 6-8 months ago. And so it really is a strange place to be with winners and losers, in the private M&A markets. But I guess it is what it is. Chris, I think we got to wrap this up. This was a great conversation today.
Yeah, absolutely. Thank you again to Paul and Winston and Salita for your insights. You make us better, and you make our friends and clients who are listening in today better as well. In addition to this webinar series, we've been holding a variety of timely topics, webinars and events that cover a number of interests. Next week, coming up on September 29th, Tuesday, we'll be hosting a session called MP Impact and Recovery, with a focus on the Chicago area. So buying and selling in a pandemic and beyond. We've seen some regional effects of market turbulence and COVID, and Chicago has a particular flavor. It'll be a discussion by a variety of leaders to explore how deal making has been impacted in the Chicagoland area. You can access recordings of this webinar as well as past webinars in our series by visiting our website at nixonpeabody.com. While you're there, you can sign up for alerts and mailing lists, and you'll find a wealth of information about the deal-making environment and how to navigate these interesting times. So thanks again, everyone, for being with us, and we will see you again in a couple of weeks.